All right, folks, welcome back. This is another episode of me documenting my day-to-day process that I'm taking to achieve long-term consistency in the financial markets. And in today's session, for the third day in a row, I had another small red day. Now, I keep stacking up these red days, but my risk is very well managed. The issue is I am simply not taking enough winning trades. That's it. I've only had 3 winning trades this month. I'm still profitable on 3 winning trades because my risk is so well managed. But this week I'm just having a problem being on the wrong side of the market. Out of all 4 days this week, look at the trades that I've taken. Short, 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 short. Okay. So 100% of the trades I have taken are longs. Let's see what the market's done this week. Monday, Tuesday, Wednesday, Thursday. You see what I'm getting at? It's kind of an issue. Now, kind of how I've been trained to think by studying ICT is if the market has gone too far, it is too high in a premium for me to want to buy it. So the only thing that I can do is really look to fade that. And I catch myself in this situation so many times intraday where the market has just gone higher and gone higher and gone higher and gone higher. And that's what's been happening literally every single day this week because the market is now approaching all-time high on the front month contract, on the continuous contract. It's already breached the all-time high. So things have changed. The market has left the consolidation range and now conditions are just different. And we're just going higher. We are not going lower. But that's something that I realized that today. I'm like, dude, conditions switched. We were in this consolidation where there's just nice clean swings up and down, but now it's just up and that's it. And every move lower is just boom, stopping just like that, and the market just continues to float higher. And that's something that I gotta adapt to. But the thing is, it's Thursday. There's only one more day left this week. I'm probably not gonna take any trades tomorrow because this market has already done so much this week. It's probably gonna be shit tomorrow. That I haven't had the time to adapt to that. So in today's session, I'm gonna break down what I was going through. I'm kind of building off the problem that I basically just described, okay? So going into today's session, this candle is not like this at all. It's, what does it look like? Let's just pull up the daily recap. Okay, go pre-market. Today my bias is bearish because the market has gone so far again before the open with engineered sell side from the overnight session. Market has made 3 consecutive drives higher pre-market and failed, so I'm not really seeing any strong reason for price to go back there. Even if it does make a new high, I still wouldn't look to buy that. So how I've been trained to think from studying the 2024 mentorship is when the market is just so high, I'm not looking to buy it because it's too high in a premium. And the way that I trade ICT, the way I've been trained to trade by studying ICT is we look for reversals. This kind of trading style does not work well on trending days at all. But today there was a large drop lower that allowed you to get on side with the move. It wasn't necessarily just an all-out go higher trend day. And I caught that. I noted the switch in price, but going into today where the market opened, I'm just like, I'm bearish. I'm not bullish at all. So let's drop down to a 4-hour. Okay. So going into today, what I see is number one, I'm noting this down candle. And I'm noting the potential for price to drop into that down candle and trade higher, do something like this. But because the market's so high on the day, I cancel out the idea. I'm not seeing that. Let's go to the 1 hour. And this is what made me really want to be bearish on the day, okay? We can see that this candle drove above this high, closed lower, and this candle drove above that high and was painting. It was painting as that new driver came out. Now we have 3 consecutive drives above previous highs that failed, and below, the market is smooth. If we go to the 15-minute, I note these lows as my draw on liquidity because if you go to the lower time frame, look how smooth these lows are. Very, very smooth. Very, very clean, very, very smooth. So, when the market is driving above previous high once, twice, and then boom, failing on news, I'm looking for the market to draw to this level. So I'm not thinking that the market is going to draw up to these highs, at least until it delivers something below the market price, which is going to be these lows in my eyes. So I was not bullish at all going into the open. I see this large drop down. I annotate this gap. Here's your 5-minute SIBI. There we go. Current interval and below. And number one, I'm noting how this candle traded above the midpoint but closed below it. It's a sign of weakness. We dropped down here, poked below those lows, started trading higher, so we did not see a continuation of this move down. I was considering taking this up candle because this large candle that overlapped it following this information right here. I was considering taking this as a sell, but I always know that I'd never take any good setups pre-market. I have to wait until the bell. So I'm like, dude, calm down, hold on, wait till the open. Right before the open, this candle opens here, trades up, drives above that high, but it closed much, much lower, still below the midpoint right there. So that's a sign of weakness. These are the confirmations that I get to confirm that the market is telling me it's going lower. These are the things that I follow. Now I just have to pair that with a reason for it to go to the other side of the market price, which would be this. Because with the logic that I trade with, this is liquidity, and the market seeks liquidity. If it gives me this information right here that tells me it is weak and it should go lower, and there's a reason for it to go lower, that's my model. That's what I do. That's it. And I'm not thinking it's going to go back here, because this high went above that high, and that high went above that high. And I read the shift down here after this sell occurred. So if we drop into the 1 minute, and note how this candle also opened at 9:30, right? We opened, we traded above that high. We still close. Well, now we're closing outside of the gap. So now the market has left the gap. It has opened here, it traded up, and it failed and closed outside of the gap. It's left it. The following candle opens, trades up into the low of it, rejects it, and closes near its low. So I think the sell, I wasn't confident in taking this thing short until the 940 candle targeting that low. So on the 1 minute, with everything in mind, on the 5 minute, here's my read on price. I don't like coloring these things pink. I need to change that. We can annotate this too, but let's do this instead. That's better. This and that. Boom. 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 Sure. Okay, cool. All right, so as the market's dropping lower, I'm like, wait, the news kind of did just form relative equal highs. So now there's a reason, liquidity, for the market to go back there. We also have data high that's left intact. Data high is always a draw on liquidity as well. So I'm going to put a 5 minute side by side with this. So you can really get a read. This is only on the 1 minute. And I kept this on the 5 minute at the time, but I didn't have it on the 1 minute, so it looked like this. There we go. This is what I was looking at in the moment. So this is the high of that 5 minute range right here. You can see it right here. This is that high right here. At 9:30, the market opens and drives above that high, taps that gap, fails, makes the high of this candle right here, closed lower below the midpoint of that 5 minute gap. Now, had I had this 5 minute gap annotated on the 1 minute chart, maybe things would have been a bit different because I would have seen this information right here. Boom, boom, on the following two candles. Look where they open. Look where this candle closes and the following opens, and then boom, leaves the gap. This candle trades up into the gap, closes off of it, and this is what I actually framed my sell off of. But you can see how the market takes the previous 5 minute candles high and fails like that, also tapping this gap. I see this at 9:30 and I'm thinking, sell it, bro, sell it. But I can't. I can't because the market literally just opened and the close of this candle is not really what I want to see, you know? If this candle closed something like this after doing that, then I'm obviously thinking, boom, it's going short. But it closed like this and it drops down also into the gap below and close above. That's the thing. I learned that if I'm not in submission to my draw on liquidity, then it's easy for me to look at information that tells me the market should go higher and lower at the same time, which makes me less confident in executing on the idea that I was looking for going into the market open. So because at the time, I was reading information that told me that this could go higher and information that this could go lower, I'm not confident in executing on my plan that I had going into the open. Therefore, I can't sell short here because I'm reading this below is bullish, but this above is bearish. That doesn't give you, so I learned that you have to be in submission to the level that you're looking for. Like, look, I'm looking for this level. So I'm filtering this out as noise because I know that the market wants to go down there with confidence. Why? Because I've seen this happen so many times before, because of what this candle gives me right here on the 5-minute, because of what the higher time frame is showing me. The market has drove above that high and failed, and now it's driven above that high and failed again, and the bodies are now lower than where they were previously, and they're still closing in the midpoint and in the lower quadrant. That tells me that it's going to go for this level. So the higher time frame is telling me lower. I read the lower time frame and it could be telling me higher. So there's that mix of information that makes you less confident in your executions, makes you less confident in your ability to execute the plan that you're looking for. So finally, it's not really obvious to me that this thing's going to go lower until it breaks lower. Boom, on this candle, leaves first presentation. Now at this point, I'm noting the conditions are very high resistance, meaning the market is just facing high resistance, working towards this level down here. How do you know that? Because of the overlap. See how there's just a lack of separation between the candles, which would be like gaps like this. Each range is overlapping the previous, like that. So when I finally get this separation here, and it's the first presented gap, it's the first gap that's formed after 9:30, I'm like, yep, that's a sell. Now I'm going to be very, very late with my entry because the market is high resistance. So I'm not going to expect precision around this gap. I'm not going to expect the market to just trade up into it and then trade lower. I'm going to expect some coloring outside the lines with the wicks, but I want to see the body still respect that gap. So that's why instead of selling short right here, I'm going to sell all the way up here because I'm anticipating the market to color outside the lines of this gap, but still respect it, indicated by where the bodies close. But I'm expecting a lack of precision because of the conditions. So that's why I don't sell on the high of this candle right here, or the low of that gap. So I literally had the perfect entry. Look at that sell right there. Boom. At the low of this up candle, I'm anticipating to act as bearish order block because it gets overlapped with this, boom, huge down candle. Tags me in, breaks lower. I'm like, okay, this is looking like a good trade. I'm thinking it's just gonna boom, boom, run right down into that liquidity, but it doesn't do that. This candle opened, traded below this low, closed up back inside the range. And this has literally happened to me, I think, like 3 times this week. So at this point, I'm like, shit, the market's gonna come back on me again, and I'm gonna realize the full risk on this position, which my stop was above the order block high. So when I see this information down here and the market fails to stay heavy below this low and closed up back inside the range, I'm very, very quick to choke the stop, and I trail my stop to break even, which is why I get tagged out there, which is the last thing I should do in high resistance conditions. If the market's in high resistance conditions, the last thing you want to do is trail the stop because you're going to choke the position. You have to give it room to work because in high resistance conditions, you're going to see a lot of deep retracements before the market delivers what you're looking for, because that's just the delivery in price when the condition is like this. You're going to get these deep retracements. So that comes back and knocks me out. And then boom, the market delivers the draw on liquidity. Now, that's this trade. This trade, extremely frustrating. At this point, I read the reversal here because boom, right during the macro, the market becomes very fluid, very liquid, and I'm like, yeah, okay, definitely reversal has occurred, and I want to look to buy this down candle right here. So I placed my order somewhere in here because I anticipated at that time the market to still be high resistance and have a deep retracement before it did something like this. But what I failed to recognize is that the market was now moving fluid, clearly indicated by this leg right here. Very, very strong, very, very fluid. We're not moving in this kind of fashion right here. So what I've noticed is what separates the real move of the day versus the Judas swing is how high resistance the market is. You can see that the Judas swing is very high resistance versus what makes the real move very clean, very fluid, very liquid. So I was looking for a retracement down into here, but since the market flipped from high resistance to low resistance, it does an institutional order flow entry drill on this gap right here and keeps trading higher. So I never get my fill on that. So I'm like, okay, botched this sell, missed this long. What's next? You know? And I stick around. I should have left at this point. I'm like, you know, I'm kind of cheering myself on for getting the read on price correct. I say, let's see. It's getting really late in the AM session and price has done what I was looking for without giving me enough of a retracement for me to buy it. And for that reason, I'm out soon. I was going to say I'm out right here and just be done on the day. But then I was like, nah, I don't want to be done. I want to stick around. I was just going to say that. And I said, no, I'm out soon. I want to stick around till 11. What happens when you stick around after you know you should walk away? Never anything good. Tell me something good ever happens when you stick around after knowing you should walk away. Never. Ever. So, when I see this candle trade up, take that high, close below it. Look at the 1 minute. What we got. Balanced price range. I'm asking myself, okay, you know, it could reverse there, but is there a reason for it to reverse? No, there's not. Is there a reason for it to draw the other way? Question mark? No, there's absolutely not, which is why I'm asking myself that, because there's actually not a reason for it to move the other way. If the market has already made the Judas swing on the daily range, clearly indicated by a failure to close the opening range gap, the body of the candles close above consequent encroachment, and these candles close above that hourly gap, that's a clear indication of strength, and there's relative equal highs above. The market has taken those relative equal highs and shown consolidation, which shows no willingness to break lower, shows me that it's very comfortable where it's at, so why would it go lower at this point in time? Well, the only reason you're taking this trade is because you wanna make something out of the session. That's why. So at least this wick, go to the 1 minute, and within the wick, I see this balanced price range, right? So I'm thinking I want to see the market drive up into that and then look for confirmation to sell it short if it gives me that. And then this trade was just very, like, there's nothing in the chart that actually told me, yo, sell this. I just jumped into this trade. What does this tell me? I'm lacking setups. I mentioned this in my previous video. I am lacking setups. This is a setup right here. This is a setup right here. This is a good playbook where the market is gapped up in the overnight session. The daily chart is bullish. The market trades down, fails to close the opening range gap, and there's smooth buy side above, a reason to go that way. Like, this is a good long setup, meaning something that's going to repeat over and over and over again. Now, I played the short side of this, which wasn't a terrible idea, but here, what are you doing? The market's at all-time highs. Why are you trying to fade it? Number two, you don't even have like a reason to fade it. There's nothing in the chart actually telling you, yo, sell this. So basically, I just sold it because I watched this candle drive above these highs, and then because this candle traded into the gap, close below it. This candle traded into the gap, close below it. This candle traded into the gap, close below it. Is there ever a large down candle like this that confirms the market's reaction out of this gap? No. I sold short as the market was painting this, trying to do some crazy shit and just sell the absolute high here. That's kind of what I was thinking at the point. Yo, I'm so good at trading. Let me sell the high right here. Bro, look. Zoom out. Yeah, that's what the market's doing. And you're trying to fade that. So that's pretty much it, dude. Like, hopefully y'all can learn from my mistakes. So, check this out. Here's my new process in documenting everything on a day-to-day basis. Yesterday, today, small losses, risk is minimal. Pre-market game plan. What was my bias? Why? Annotate, daily down to 1 minute. Live trading. What was I thinking at 9:45? What was I thinking at 9:50? What was I thinking at 9:55? What was I thinking at 10 o'clock? What was I thinking at 10:15? Intraday thought process analysis. At this time I was thinking this because of this. At this time I was thinking that because of that. Review. What did I learn from my intraday thought process analysis? Post-market analysis. How did I feel going into today? My approach versus what happened. My approach, what happened. What I was going to do and how did I execute that? What was I going to do? This. How did I execute that? That. What did I miss? What did I get? Reflection. What did I learn? What did I do wrong? What did I do right? Post-market study. What's the price actually deliver and why? My bias was correct. Here's why. I switched my bias 4 times intraday before the 10:15 candle finally converted over to be a seller. And boom, that's it. It's kind of like my new process. So I'm going crazy with the data collection. I'm starting to get really serious with my numbers and looking at them and being like, these are my statistics. My statistics and my data is going to show me where I'm going wrong. Like right now, I am simply not taking enough winning trades. So that tells me that my setup selection is bad, probably because I still don't have any setups defined, which probably tells me I should take some time away from live trading to do a lot of backtesting and defining the setups I look for, which is going to take a lot of work, probably months. So that's it for this one. See you.